It's Brian Preston, the Money Guy.
But if you look at what's going on in the stock market this year, it's been fairly ugly. We just closed out the third quarter and it's not looked fantastic. We are fully in bear market territory this year. And so we're seeing headlines like this. The stock market rout looks like the dot-com bust of 2000. How low could stocks go? Much further, says Wall Street analyst. Dow tumbles as America's prices keep rising. The Fed could crash the housing market. Bond market is crumbling. I mean, there are headlines all over the place suggesting how ugly the market is right now. And they're not entirely untrue. If you're looking at it in a very fixed window of time, 2022 has not been like the most fun year for most investors.
Well, I think it's what makes this really ugly is that when I've been managing money professionally in the past, diversification it's incredible how you could, like I remember the dot-com. Everybody talks about the dot-com, but what they don't remember, and this is what I love, is that having the experience of managing money in the 90s, heading into 2000s, is that yes, equities got crushed, but if you had real estate, you made money. You made money on real estate. Your bonds did pretty good in that dot-com. So the diversifiers in your portfolio actually carried you nicely to where I remember when we were managing money, even though the equity market in 2001 was down like 13, 14%, most of our clients were basically at break even because the diversifiers protected them in a lot of ways. What makes this so ugly in 2022, we know equities because they have these cyclical 2 out of every 10 years. We're going to hit these bear markets, these things that really hurts, but you know you're building. This is where the premium comes for taking the risk to get that reward. But bonds, because interest rates are going up so fast, bonds are getting squeezed and crushed in a lot of ways. And that's why when you see headlines like the bond market's crumbling, this is taking away diversifiers. This means even people who on a risk scale thought they were safe. Now look, they're not losing. I don't want to get too out in front of my skis here where I say those bonds are crushing it. No, they're losing at a much slower scale than what equities are doing. But still, it's disheartening when even what you perceive as safe actually has vulnerability. That makes it a really ugly economic thing.
And here's another thing that I think is interesting. If you look at the S&P 500 year to date, you just look at the first 3 quarters of 2022, it's down a little over 25% as of 6/30. I think that this is such an interesting thing to note. There is a behavioral bias in the world of finance called recency bias. We always remember the things that have happened most recently to us. When you look over the last couple years, we saw a significant downturn in the fourth quarter of 2018. Market lost over 20%, but then it immediately came back. It made the money right back. So it went down, came right back up. Well, then from a market perspective, we saw COVID in 2020, where again, the market dropped and it immediately came back up. And so now we as investors have been conditioned to believe, oh, downturns are fast. They happen fast and they recover fast, and it happens inside of a quarter. This is really the first time in a number of years where we've seen an extended period of downward movement. And what I think has been so painful for the average investor is there have been fits and starts this year. You know, first quarter was down and then it recovered a little bit. And then second quarter went down again and then it recovered a little bit. And then third quarter got hammered. We're forgetting that in those 2 out of 8 years that the market is down, this tends to be more of the norm, not what we saw in fourth quarter of 2018, not what we saw during the COVID downturn. We just have to remind ourselves of that as long-term investors, this is part of the reason why we receive the risk premium. This is why we make money in the markets over the long term, is because there's risk involved in the short term.
Well, I think you make a great point. I mean, even good years, inner year, there's typically, and I'm doing this off memory because we didn't pull this slide in. It's 13, 14% is what I had in my head is the inner year volatility. But it is true. I mean, this has been a more drawn out loss. And that's disheartening. I mean, we think about that for clients all the time. Is like, man, we just need them to keep the metal about staying the course on this because I know it really hurts you. But here's and you said something there I want to make sure that we're clear on because we're about to transition into that good news, is that, yes, the downturn can actually be more prolonged, whereas we've gotten so conditioned to thinking it's all fast. But I do want to remind people, he wasn't wrong that the recovery actually is fast.
It's a V.
But remember, to get that fast V-shaped recovery, You actually have to stay the course. So
right.
do not let the ugliness of this, the disheartening where you win a few battles, but it seems like the war is lost because we keep going down further. Stay the course, and then we can transition into the good side of all this so you know how to really turn all of this knowledge into actionable information for your financial life.